So what happens when a trust or estate finally closes up shop? What about all those last-minute tax deductions? For years, the answer was pretty straightforward. But then a massive legislative storm nearly wiped them off the map, only for a surprise regulatory fix to bring them back stronger and more valuable than ever. We're not just talking about filing one last return. This is about a fiduciary's final opportunity to hand a powerful tax shield directly to the beneficiaries.
Here's what we're going to cover. We'll start with the crazy timeline of how these rules went from stable to nearly extinct to even better than before. Then we'll dig into the legal bedrock, Section 642-H, that makes any of this possible. We'll get into the nitty-gritty of who actually gets to claim the deduction. Then we'll relive the crisis caused by the Tax Cuts and Jobs Act, see how to report it all on the K-1, and most importantly, wrap up with how smart planning can turn this final filing into a major win.
You know, for the longest time, the rules for an estate's final tax return were basically set in stone. It was settled law. Then, back in 2017, one little line in a huge new tax bill just threw everything into chaos. It created this period of real uncertainty until, out of nowhere, a regulatory fix not only saved the day, but actually made the outcome way better than it was to begin with.
So before 2018, everything was predictable. Leftover deductions from a trust or estate would just pass through to the beneficiaries. They'd claim them as miscellaneous itemized deductions, which, had some income limits. Then bam, the Tax Cuts and Jobs Act comes along and just suspends all miscellaneous itemized deductions. For a couple of years, everyone was in a panic, thinking these incredibly valuable tax assets were just gone. Then finally in 2020, Treasury Decision 9918 arrived, and it didn't just save the deduction, it completely transformed it.
So how in the world can a tax deduction even survive after the entity that created it is gone? I mean, think about it. Normally, it can't. When a taxpayer ceases to exist, its tax attributes usually just vanish into thin air. But Congress knew this was unfair for estates and trusts, so they built a special bridge, Internal Revenue Code Section 642H.
All right, let's get specific. The key phrase here is excess deductions. Section 642H2 defines these very clearly. They are the deductions from the final tax year, and only the final year, that are more than the estate's gross income for that same year. Now, this doesn't count things like the personal exemption or charitable gifts. We're talking about those final administrative costs, the legal fees, the accounting fees that just couldn't be soaked up by income before the entity shut its doors for good.
Now, this bridge, Section 642H, isn't just a one-lane road. It actually carries 3 different kinds of tax goodies over to the beneficiary. The first 2 are carryovers from previous years that were already on the books, net operating losses and capital losses. But the third one, and the one we're really focused on, is totally different. It's the excess deductions that are created specifically in that final year. And believe me, that distinction is absolutely critical. And this is a point you absolutely cannot miss. The IRS interprets last taxable year with surgical precision. If a trust pays a huge legal fee in the year before it terminates, and it doesn't have income to offset it, that deduction is just trapped. It's lost forever unless it's a net operating loss. To pass through to a beneficiary under this specific rule, the expense has to be paid in the tax year the entity terminates. Timing is literally everything.
Okay, so we know these deductions can make it across the bridge. But here's the million-dollar question. Who's waiting on the other side to catch them? Not every person named in the will gets a piece of the action. The regulations set up a very clear test to figure it out. It's all about the economic burden.
The Treasury regulations spell it out perfectly. It's not about who gets the most money. It's about whose share of the property was actually made smaller by the very expenses that created the deduction in the first place. The bottom line is this. If your slice of the pie got smaller because of these final bills, you get the tax break that comes with it. It's that simple. So this test creates a really clear pecking order. The residuary beneficiaries, the folks who get whatever is left over, they're the primary ones who qualify. Their share is the first thing that gets hit by costs. On the other hand, someone who's supposed to get a specific amount, say $50,000 to Bob, usually doesn't qualify. In a solvent estate, Bob gets his $50,000, period. But, and this is a big but, if the estate is insolvent, if it runs out of cash, and Bob's bequest has to be cut to pay the final bills, well, now Bob has shouldered an economic burden, and now he qualifies for a piece of that deduction.
This chart lays it all out perfectly. Look at the solvent estate. Beneficiary A gets their $50,000, no problem. That $20,000 in excess costs comes right out of the residue, so B and C bear the burden, and they split the deduction 50-50. A gets 0. But now look at the insolvent estate. The residue is gone.
A's bequest is now short by 10 grand just to cover the bills. A has now shouldered half the economic burden, so A gets half the deduction. It all hinges on who actually felt the financial pain.
Okay, let's get to the real juicy part of the story. The Tax Cuts and Jobs Act wasn't even aimed at trusts and estates, but one of its provisions created this massive, unintended consequence that sent shockwaves through the entire community.
And this right here, this is the line of code that threw the entire estate planning world into a tailspin. Section 67G. It's so simple and so brutal. No miscellaneous itemized deductions shall be allowed until 2026. Since these excess deductions had always been treated this way on the beneficiary's return, the plain text of the law basically said they were gone. Just poof, an entire pillar of tax planning was about to crumble.
So how did they fix it? Honestly, the solution in Treasury Decision 9918 was brilliant. Instead of treating the excess deduction as one giant blob, the regulations broke it apart into 3 buckets based on what the original expense actually was. And bucket number 1 was the absolute game changer. This bucket is for expenses that are unique to running an estate, things like executor fees, legal fees. The regulation said these are not miscellaneous itemized deductions. Nope, they are above-the-line deductions, which means the beneficiary can use them to directly lower their adjusted gross income. It's a much, much more powerful tax benefit.
And here's the craziest part. This fix was a massive upgrade. Before all this chaos, these deductions were itemized and subject to a 2% AGI floor, which meant for a lot of people, they were worthless. You could only deduct the amount that was over 2% of your income. But after the fix, they became this amazing above-the-line deduction that reduces AGI dollar for dollar. In a truly wild twist of fate, the crisis that almost killed the deduction wound up making it more valuable than ever before.
Okay, so that's all the theory, but how does this actually look on a tax form? The fiduciary has a critical job. They have to clearly communicate the exact nature of these deductions to the beneficiary, and the official channel for that is Box 11 on the Schedule K1.
This is it. This is where the rubber meets the road. All of these excess deductions that get reported right here in Box 11 of the K1. But it's not just one number. The fiduciary has to use specific letter codes that tell the beneficiary exactly what kind of deduction they're getting. And that code dictates exactly how they can use it on their own 1040. Now, the 2 codes you'll see most often are A and B, and they are not the same. Code A, that's the golden ticket. Those are the powerful above-the-line admin expenses that directly slash your AGI. Code B is for things like state and local taxes. Still good, but they go on Schedule A as an itemized deduction, and they're subject to all those other limits, like the $10,000 SALT cap. Getting this coding right is absolutely essential.
All right, so now that we know all the rules, this is where we get to play offense. A smart fiduciary can go way beyond just filling out the forms correctly. They can actively plan to create and maximize these tax benefits for the people they serve.
There are 3 core strategies here. First, timing is everything. Since these deductions only count in the final year, you should intentionally try to defer paying big bills, like legal or accounting fees, to stuff them into that final return. Second, you can manage the termination date itself. You have a reasonable period to wind things up, which might let you push the termination into the next year if that works better for the beneficiary. And finally, harvest losses. Selling assets at a loss in the final year creates capital loss carryovers, which are often even better for a beneficiary because they can be carried forward forever.
And why is all that planning so important? Because of this one simple, brutal rule. It's use it or lose it. Unlike those capital losses, the excess deductions we've been focused on, both Code A and Code B, are a one-shot deal. The beneficiary gets to use them in the single tax year the estate terminates, and that's it. If they don't have enough income to use up the whole deduction, the rest is just gone forever. That's what makes this planning so vital.
So, I'll leave you with this thought. After this whole journey from stable law to crisis to an even better opportunity, is filing that final Form 1041 just another compliance task to check off a list? Or is it the fiduciary's last best chance to actively create value, turning what would have been lost expenses into a real, permanent shield for a beneficiary's wealth?